Tonight, the Federal Reserve Bank is ending its weeks-long quiet period and giving us the chance to answer questions about fighting inflation and avoiding a recession. Our Jonah Kaplan reports on what rate hikes mean for the economy and our bank accounts.
The United States economy is both an ocean and an ecosystem, with money flowing in all directions. The ocean's tide, that's the business cycle. High times of growth and prosperity, low times of debt and unemployment. At the top of the economic food chain is the Federal Reserve, the central bank of the United States. The Fed, as it's called, lending money to big banks and local banks, which loan money to help businesses expand and help people buy homes, cars, and anything else they might put on a credit card. Money, though, costs money, and paying interest on those loans is how America's economic ecosystem sustains itself. How much it costs to borrow money, that's how the Fed tries to keep the economy afloat, no matter what the tide brings in. The smoothest ride is one with stable prices and maximum employment. But how often is an ocean as calm as a lake? That 1-minute primer that you just watched, it sums up the balancing act of more than 100 years of monetary policy in the United States, which of course is set by the Federal Reserve. The Fed having 12 branches across the U.S., including this one here in Minneapolis, Minnesota. When interest rates go low, there could be more people with more money, empowering those people to buy more goods and services. When demand goes up, though, supply goes down, and those goods and services get more expensive, inflating the price of said commodity. When interest rates go high, people pull back on borrowing and cut down on spending. Now businesses and companies aren't generating as much revenue, making it harder for them to stay open and keep employees on the payroll. Abigail Wozniak is a senior economist at the Minneapolis Fed.
Balancing and trade-offs are things that we talk about all the time here.
In March 2020, the U.S. government forced to weigh saving American lives versus protecting American livelihoods. At first, it was impossible to do both. The stock market tanked, unemployment soaring to 20%.
Very sudden and very sharp. There's graphs upon graphs I could show you that, involve, what we think of as big swings, right? The Great Recession was a big swing. When we plot employment now and add the pandemic on the end, it almost makes the Great Recession look small because the changes that took place were so large and dramatic.
People forget what it was like in 2008. I mean, I don't think they even remember what was so bad, where people were hungry, people were homeless. People don't remember that.
I think certainly some folks have, it has receded a little bit, but I think many folks do remember. I think folks experience that really keenly. Some people have not yet recovered in terms of their financial position to where they would have been, certainly if that event had not happened. Really was no playbook for this, but there was, I think a well understood sense that this was going to involve some dramatic slowing. It was going to involve a need for innovation and flexibility and rapid reactions.
To help stop the bleeding, President Donald Trump signing into law relief packages that included sending direct checks to American households and payroll support to American small businesses. President Joe Biden continuing and expanding that fiscal policy with the $1.9 trillion American Rescue Plan. The Fed, meanwhile, tweaking its monetary policy to allow for more emergency lines of credit for banks and lowering its benchmark rate, called the federal funds rate, that sets that price for how much it costs big and local banks to borrow money. How do you know, or how does the Fed know if it's doing too much too quickly?
I think the easiest answer to that is we watch a lot of data. And so there are a lot of us paying really close attention to the indicators that are coming in, trying to understand, in real time, where is the economy at right now? Where is it likely to go in the next several months to several years? Well, recovery equals jobs, right? So recovery is pulling ourselves out of the decline in employment that we experienced and building back to those higher employment levels that we had going into the pandemic.
The data showing that's generally what's happened, along with record low unemployment. But it's not all been good news. The checkmark recovery, imposing an insatiable demand on goods and services that scaled back production during the shutdowns. The global pandemic, meanwhile, disrupting a global supply chain of commodities and raw goods that rely on global shipping lines, all of whom are based outside the United States. Add in a war in Ukraine and tensions in Asia and the Middle East, inflation soaring to 8.6%, the highest level in 40 years, with the average U.S. family spending $350 more per month to buy the same amount of goods they bought last year.
When you're going food shopping in your car using gas, you're also experiencing some of these other international shocks that we're also contending with right now. Right. And those all feed into the price level.
It's not a shock, then, that the Federal Reserve is trying to bring back the balance of the economic forces by raising that benchmark interest rate. The announcement on June 16th to raise rates 0.75 of a percentage point is the steepest climb since 1994. Now that it's more expensive for banks to borrow money, they'll in turn make mortgages, auto loans, student loans, and holding credit card debt more expensive too. The risk? Pumping the brakes too hard. There could be some whiplash.
The idea is if everyone pulls back just a little, not a lot, but a little, then it could give the economy some breathing room, so to say?
Right. And that is the great thing about prices. And that is, and an interest rate is a price. So that price mechanism gets people to act a little bit differently, slow down their spending. Yeah.
You're basically telling people to save money.
We provide an incentive for saving. Higher interest rates will do that.
Where is the confidence, though, or how do you remain confident that it doesn't cause us to go into a recession?
That is the goal. And I think there's really, we have a really good shot at that, given the strength in the economy right now. But that is the challenge.
Should the U.S. dip into a recession, economists at the Fed and beyond certainly hoping it's a shallow one. There are things you can do now to prepare, including paying down debt and boosting your savings.
So maybe you splurged a little, maybe the first 6 or 12 months after you were out of lockdown, you spent pretty freely. Maybe this is a time to say, do I have 6 to 12 months of my living expenses set aside in a boring, safe savings checking money market account?
Riding the economic wave? That might not be such a bad thing either.
You're not investing for the next 6 months, probably not even for the next 2 years. You're investing for decades in the future. Sometimes the very best advice is, that little devil on your shoulder says, don't just sit there, do something. I turn it around and I say, don't do something, just sit there.